Thank you as always for joining us for this week's market update video. Joining me today, we have FX and Nick. The last 2 weeks, guys, 2 weeks ago, the market was, I don't want to say aggressively down, but it was down meaningfully, I think. And then last week, we've rebounded a lot of this based on headlines around what's going on over in Iran and the implications there. How do you guys talk to clients right now as it relates to markets and just sort of thinking about portfolios and investing long term right now? What are your takes on markets broadly, and then how are you sort of addressing that with clients right now?
Mm-hmm. Yeah, maybe I'll start, JR. I think it's important to kind of take the opportunity to zoom out a little bit when we're in times of volatility like we are right now. A lot of it driven by geopolitical conflict. Perspective where we've come from, and if you look at the markets the last really 3 years, we've had 3 incredible years of market returns. I think our team came into 2026 expecting some more volatility. Now, we didn't know it was going to be highly driven by geopolitical conflict. We thought perhaps more it was going to be driven by some increased valuations and stocks getting rather expensive, and we have seen that. But over the last month, a lot of the markets whipsawing back and forth has really been on real-time news surrounding the Iran conflict, and it's really hard to try to trade around those things. It's also often counterproductive to try to trade around those things, in my opinion. And this is backed by data, of course. The market tends to digest geopolitical conflicts, uncertainty, work its way in through the system, but ultimately it is forward-looking, and it generally is a positive direction that we see once we've kind of digested the news. I think right now we're just kind of hungry for a little bit of certainty. So that's my take.
Yeah.
Frank?
I'll just add, along those lines that right now, we're waiting for earnings season to start, which is coming up in less than 2 weeks. And, when we're in between data points, in between inflation numbers, there's nothing else for the market to focus on other than headline news. So you're absolutely right. I think first and foremost, we have to remember we've got a long-term game plan for our clients, and we can't let this noise, this volatility really let us stray from that. There's always going to be something to worry about. So I think that's first and foremost. But in terms of what's going on right now, the market's going to continue to be focused on the headline news, and we're still reasonably optimistic that it is in no one's best interest for this war to continue. And so I think we're going to get some sort of closure in the next month or so. And in the meantime, we just have to stay focused on the fact that we have a plan in place.
I think what's important too is to understand there's the market reaction, but there's also, I think when you're watching the headlines, when you're seeing the social media postings, etc., it feels like there's you would expect, and it feels like there would be a big market reaction. What we've seen is there's been volatility in the market, but it's not worst from top to bottom. S&P 500 has been down 9.5%. And then last week, and this was 2 weeks ago, last week we rebounded, so now we're down 6. I think when I tell folks that, the reaction is that's all we're down. We're only down 6%. I mean, you've seen the volatility in the bond market too, with yields moving. But again, it's the aggregate bond index is down 2 to 3%. It's not down. In 2022, equities and bonds were down more than 15%. And that was a really challenging year. It was a challenging month. March was a challenging month for both equities and bonds, similar to September in 2022. But to your point, FX, long term, and I think to Nick's point too, these things work themselves through the markets. We get back to fundamentals and to earnings. We'll be paying close attention to not just 1Q earnings, but also expectations going forward, because 1Q earnings aren't going to really be impacted by what's going on. It'll be about 2Q and 3Q. And then on top of earnings, it's going to be the inflation data, the employment data that we're getting. We've seen the Fed move, the market expectations of the Fed now move to no rate cuts. Seems to be the consensus for this year. But I think fundamentals, hopefully through earnings season, we can get back to fundamentals. And to your point, FX, get some clarity on the direction of where we're going with the geopolitical tensions.
Sorry, I just wanted to say, I think a lot of times what people really want to know is, bottom line, what should we be doing, and what is 213 strategic partners working behind the scenes on for me, like what are they kind of keeping an eye on? So I would tell you the three things that we think are most important are: number one, for those that require liquidity, that are taking withdrawals from their portfolios, it's really important that we have cash available and we have a strategy for how to raise cash from the portfolio, and that we're doing it from positions of strength, and that we don't find ourselves in a position where we have to sell in a down market. And I know your advisors are talking to you about that, because that's really important. The second thing that we've been doing is making sure that we're not overextended into growth and technology stocks, that we've got adequate exposure to value, energy, other sectors of the market. Because let's remember, the last 3 years have been dominated by that technology sector. And then lastly, one of the recent moves we made in our portfolios was just, we continue to believe the U.S. is the best place to be. When we look at the world, the U.S. is really probably the best positioned for the current environment. And so again, making sure that we're focused more on U.S. investments, which we think are going to hold up the best.
I'd say the other thing that behind the scenes we're looking at too is for opportunities to reinvest and reallocate. To my earlier point of the market correction hasn't been as big as it would maybe feel. So we haven't been inclined to redeploy assets into risk assets, whether it's high yield bonds or leaning into equities, et cetera, because it's the opportunity and the probabilities of markets moving higher on us hasn't presented itself to the point where we'd be comfortable making those allocations. But we're also looking at that as well. And then we've talked about in the past tax loss harvesting, especially in individual stock strategies, whether it's an index strategy or an actively managed strategy. A couple weeks ago, 2-3 weeks ago, when we were in that bigger drawdown, we were reaching out to our managers and our own portfolios, looking at those positions in tax loss harvesting where there were opportunities. So there are these little things that we can do kind of behind the scenes to add value to the portfolios that you may or may not be seeing. One of the other things I want to address in this video is we continue to see a lot of headlines around the private credit space. We've been allocators to the private credit markets for years now. We've always preferred and leaned into bigger managers, bigger corporations with investing in those sort of that mega cap space of private credit, not leaning into niche managers that are doing small deals concentrated in certain sectors, etc. We maintain exposure to private credit in a lot of our clients' portfolios. It's something we're definitely watching, because these managers, even some of the managers that we're using, are facing significant redemption requests right now. So investors, just like in the public markets, tend to, we think, panic in situations where they want immediate liquidity. And these specific structures, and we've exited ones that have to provide immediate liquidity because of this concern. We moved out of a strategy late last year. But the strategies that we remain in these managers are able to gate the redemptions, which we actually view as helpful in this structure, not as a detriment to our investors. We want to be in private markets, and private markets by nature are not liquid. So we don't want something that is promising liquidity that we can't have. So in these structures, these managers are able to say, look, investors, you want 10% of our investors want cash back. That would be detrimental to our investors. We are willing to give you 5%. So we're going to give you half. that structure is conducive to keeping our investors safe and those managers not being forced to move out of positions that they feel good about. And a lot of these strategies also, I think the market needs to understand, and investors should understand, are designed to have liquidity for these events. They have lines of credit that they can access in terms of in times of stress, on top of liquid investments in the portfolio designed to provide this liquidity. So they're not forced to go out and sell a 5-year loan at a deep discount necessarily. Now, there's managers that are doing this the wrong way and managers doing this the right way. We feel comfortable with the managers that we're using, but obviously it's something that we're keeping a close eye on because that liquidity bucket won't last forever. But we suspect this sort of panic in the private credit markets, there's going to be some losses in loans in certain managers more so than others, and we expect that. But we continue to like exposure to the private credit markets and think long term that that's the right allocation. But again, we're going to keep a close eye on these portfolios to make sure that our investors are well positioned going forward.
So JR, I would agree with everything you said on private credit. I would just point out we've seen a lot of news coverage in this space the last couple of weeks. A lot of headlines have been generated, articles in the Wall Street Journal, etc. I would just encourage anyone, if they've got questions on what they have and why they have it, reach out to us. We're happy to have these discussions. Some of these articles have been directionally correct, but perhaps don't have the full story in all cases. And we've been very thoughtful in the way that we've allocated to these managers and hold these positions for good reasons. But we're happy to provide clarity and hopefully peace of mind if anyone has questions. So reach out to us and we'll be happy to dive into the details.
Thanks for that, Nick. It's a great way to wrap up. As always, folks, if you have questions, like Nick said, please reach out to us on markets, on the portfolio. We're always happy to talk. Thank you again.